You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
You know what, Bill? Too many people run away from past picks, so-called, and I certainly didn't want to do that.
Welcome back to Mining Stock Education. I'm your host, Bill Powers, chatting today with my friend Mark Zaret. He is a successful Canadian small cap investor, as well as an advisor to a fund. And Mark, I'm bringing you back on the show by popular demand. I've been getting messages, can we hear from Mark? And knowing you don't necessarily desire to be heard, but there is demand for you to be heard. So welcome back onto the show for the third time.
Thanks, Bill. Pleasure to be here.
So we chatted about 11 months ago, and you shared 3 picks that you're invested in personally and your fund is also invested in. But you've also shared with me that the whole idea of giving stock picks out is kind of a bankrupt idea. Could you elaborate on what you mean by that?
You know, I remember one year somebody asked me for a name or two at the beginning of the year, and I mentioned a couple of names. And lo and behold, a name I didn't mention multiplied by about 30 times. And this is the kind of thing that can happen. And then the names that you mentioned, of course, don't do anything at all. So, all it's really about is a portfolio. So I think the only way you can approach this game is a portfolio, which is, somewhat, allocated based on simple math, really, for starters. Take 10 stocks, put 1/10 of your money in each one, etc. Or, if you discover them one at a time, you don't go all in, you just keep your capital, invest a portion and carry on. And at the end of the day, you have a portfolio. And so extracting anything from that portfolio is a little bit of a mug's game, but I did put a foot into that water. And so here we are. I'm not going to abandon, the ideas that I shared a year ago. I will happily update you on them. But I really do think that, the portfolio approach is how investors should go about it. And they should pay very limited attention to what anybody says, frankly. And they should use it as the beginning of their own due diligence and have their own check marks to go through a certain list of, what makes a good stock pick. And I think that's more the value that can be shared by, people who have been doing this for a long time rather than particular names. So I would say that up front. I think we did chat a bit about that in previous talks, but I just want to emphasize that all over again.
Mark, even with the portfolio approach, do you believe in being overweighted in more high conviction trades?
I do, but I think that's something that you can only develop over time. What is high conviction, and how do you define it, and how do you arrive at something that's high conviction? I think there's some experience that goes along with that. So it's not something to start off with. So again, going back to the original example, you have X number of dollars. Don't put half in one name because you are certain it's a winner. Those kinds of, gut feel is rarely going to work out for you. So if you want to define, high conviction as something that just literally checks every box, when management and there's a certain certainty and there's a certain de-risking that's already happened. So there's, entering a position in that way, no, I wouldn't advise that at all. So high conviction is something that can develop over time, and you take your 1/10 of your portfolio and you turn it into, a bigger piece, and another de-risking event happens, and so you're willing to put down a little more money and build it over time, not enter it as high conviction. So, that's typically what happens with me when I'm investing. The high conviction comes over time. It doesn't start that way because typically you don't know enough at the beginning.
And you prepared some slides to share with listeners. Can you walk us through these slides and give us a review of the 3 picks you gave on the show last year, please?
Right, sure. Yeah, I know. I was thinking about this morning, and again, with the portfolio idea approach and how important it is to stay with winners. And so I tried to actually quantify this just a little bit because of just exactly how important it is. So this is somewhat, I just created this arbitrarily, but but I think it actually can mimic a good outcome, believe it or not, like a very good outcome. And so I've taken a portfolio of $100,000 and allocated it into 10 names, $10,000 each, right? And you can pick your time frame, let's say over 1 year. You've got your one really big win. It's up 8 times and so on. So one is 8 times, you've got 2 doubles, you've got 3 break evens, and you've got 4 with absolutely nothing recoverable. And, if you were able to realize that outcome, your 100,000 is 150 at the end of a year. Now, let's say you're just starting and it took you longer and you made a few more mistakes, etc. Let's expand it to a 2-year, for example. So you're still earning 25% a year. It's still a decent return. And now if you take that result and you project it over 10 years so that you're constantly reinvesting and now your capital is growing, it actually turns into real money. And the biggest problem, I think, is that people are impatient and they think it should happen overnight. And it just doesn't. And the reality is, it takes time, a lot of hard work, and developing your method and being patient. And let's just look at that line number 1 for a second. 8 times. I mean, is that realistic? Well, yeah, we could point out some examples of even in a terrible market where you do get these kind of winners. And in a better market, believe it or not, I know, Bill, you've been around this game for a long time. It's not common, but it happens with some frequency. So, it's not unrealistic to hope for a return of that nature. In fact, sometimes they can be much larger. But the point I want to make is you'll never see an 8 times win if you sell it at a double. And, the only way you can get that kind of a winner is by sitting and watching and waiting and understanding how the story is being de-risked and staying with it. And the hardest thing I think to do is to stay with these things when they're working. But that's what you really have to do. In many cases, again, and you have to put your own analysis into when it's right to stay and when it's right to take your profit. But point being, you just simply will never get an 8 if you sell everything at a 2. So there are times where you just have to be comfortable with the progress and hold on for that bigger win. Without it, this is a losing strategy.
Without the 8.
Without the 1 in 10, perhaps even 1 in 20 that really go, you're not going to make money at this kind of game.
So the counter argument would be if you sell it at a double, at least you'll stay in the game. But what you're saying is when you factor in 4 zeros out of 10 positions, if you only sell at a double, you're not going to be in this game very long.
Exactly. It's just not enough. You really have to have those ones that really, really work out in spades for the strategy to really pay at the end of the day. Because there are going to be those ones that just don't work out, no matter how much work you've done.
So the 3 picks you did on the show last year, one was more than a double.
Yes.
One was about 1/3 of 65% down, and the other is about flat. So could you walk us through those and how you're perceiving those?
Sure. So I'll just scroll down here. I made some summary notes here. Tenaz was the big win. I can't remember the entry price when we talked, but I think it was
about $1.50, I think,
something like that.
And it's like $3.50 today.
Currently trading. Okay, so that was a pretty nice win. Now, again, there's some arbitrariness here with timing and so on. I mean,
and the ticker symbol is TNZ on the Toronto Stock Exchange, especially for audio listeners, the stock we're referring to.
Right. Yeah. I'm very happy that it worked out. It's almost equally likely that we could still be sitting and waiting for them to do an acquisition. And because a year can go by pretty quickly. But fortunately, I think it was really only just a matter of weeks after we talked, they actually did announce an acquisition. And then 3 months, 4 months later, they actually topped it up with a second acquisition, both in the area of the Dutch North Sea, mostly natural gas with a lot of other considerations. So I put this up on the screen as a summary of what's happened, but I just want to draw your attention to something that I personally find interesting, which is the NCIB. So that's where a company's buying its own stock back. And I think they got an approval for about 2.6 million. But because it was such a low volume stock, they were only allowed to buy about 6,000 shares a day, which is really not much stock. However, if you take, about 250 business days a year and multiply it by 6,000, you end up coming up with a number of about 1.2 million, which is what they bought back. So they were basically in the market just about every day, buying back the maximum number of shares that they could. And I think what's remarkable about that is that a lot of companies put out these notices because they think investors treat them as a bullish indicator, which in fact they are, but they don't really have the intent of making good on them. It makes for a nice press release. Then you go and look at their balance sheet and you sort of scratch your head and go, how are they going to be buying back their own stock? They don't have enough capital to run the company. So it's important to, when you see these kind of press releases, to make sure that the company's actually adequately cashed up to even to begin the process of buying back shares. And then it's good to watch over time and see if they actually proceed with it. So in the case of Tenaz, they really did their best to follow up on what they said they would do.
And this is an energy stock, and this was a bet on management is what you had told us previously too. It's like functionally a shell looking with some cash, looking for a project, and the management team had a good track record, and so you placed a bet on management. Yeah,
that's correct. Management is the number one consideration, I think, in this game, and that's why it was, I think, the first stock I mentioned. That's why, I was very excited about it. Tony Marino is the guy who leads the team. He's been involved with a number of very large enterprises that he's played a significant role in building. Just to correct you, though, well, it wasn't entirely a shell. They did have their Leduc asset in Canada, in Alberta, as a starter. And it was I believe it was around 800 barrels a day. So the company has literally tripled in size. And I think it's well worth noting that they actually have less shares outstanding today than before the acquisitions. So I've never seen this before, to be honest, Bill. I've never witnessed anything quite like it. The share count, being lower after all this accretive basic, this work they've done. So I think that just says more about management and how they're trying to, build this company and share the wealth with existing shareholders rather than expanding the party to too large a base. How often do you see a company go from, say, 10 million in market cap to 100, but if there's 10 times as many shares out, the price has not changed. So the fact that they've done all this without issuing shares is frankly quite remarkable. And they've mostly done it with assuming decommissioning liabilities. And so those are debts that are quite far down the road. And there's something worth saying about them as well. Over time, sure, you could argue they could go up, they could go down, and it's valid to say that. But in a way, I look at it as a loan to be paid off in future, likely not to be exceeding the rate of inflation, and possibly improving, over time. But just the fact that they keep that capital today and having the ability to use it to some degree. It's probably mostly on their balance sheet as restricted cash, but nonetheless, I think it was quite brilliant of them to be able to acquire these acquisitions through simply taking on the decommissioning.
So this is one you would hold. You're already up over double your money, but you're holding.
Absolutely, haven't sold a share, and in fact increased the position, well after we spoke, and at higher prices. Which we can get into that as well if you like. I think I know personally it's very hard to pay more than you've paid previously, but again it's that de-risking factor that comes into play, and the advancement of the story, the advancement of the liquidity of the trading.
So even though the share price is higher, the value proposition is cheaper.
Well, it is actually. It's still one of the cheapest stocks I can find. It's still like 1 times
cash flow.
Yeah, so it's still a cheap stock. Just back to that NCIB just for a second. With the average shares per day now much higher, they've reintroduced that buyback program with actually less shares because there are less shares outstanding. But with the volume being higher now, so now they're able to buy more shares per day, and they've got a significant amount of cash. So just the other day, they bought 35,000 shares out of the market at over $3, in the low threes. So again, I think this is a good example of a story that, for me personally, you don't sell.
If their business plan is acquisitions and accretive acquisitions, structured favorably, is a rising oil price, and let's say a dramatically fast rising oil price, would that be one of the threats to this investment thesis?
Well, that's where you get your alpha from. So you've got your great management group, and now you ascertain, well, is there wind at their face or wind at their back, right? And with a rising price, these acquisitions just become even richer.
I guess what's behind my question is, could it hinder future acquisitions if those assets that they would otherwise be able to pick up cheaper during a lower commodity price are valued more, so the sellers are less eager to sell them?
Sure. I guess, sellers will become a little tougher in a rising oil market. But, what they have done, and I think smartly, is they've focused on parts of the world where there's less competition. And so they're not at all interested in the US as far as I understand, because, for every asset that comes for sale, I think they were mentioning in a presentation that there might be 8 or 10 bids, if not even more. And in parts of Europe, and Africa, there might be only 1 or 2 bids. So yes, you're correct. It might make it a little more difficult for them to continue on the acquisition trail, but they are targeting areas that are not as crowded, and I think that will work to some degree in their favor.
Anything more to say about Tenaz Energy before we move on to the next one?
No, I think that pretty much covers it. I mean, they've got a significant amount of working capital. I suspect they'll be, I don't know when, tomorrow, in a year, 6 months, there will likely be more acquisitions. I mean, they've been pretty clear that they're looking to build a mid-sized oil and gas company here. So, you might want to ask, well, what kind of hiccup would cause you to change the view, right? When do you walk away? I mean, if I started to see very large share issuances for deals that didn't seem to be quite as rich, maybe I'd start to feel a little queasy and decide, maybe it's time to start looking at lightening up a bit. But no, for the time being, it's a keeper.
And moving on to our next one.
Moving on, I believe the next one I mentioned was Fortune Bay.
Mm-hmm.
It's probably worth mentioning, Bill, that, in this kind of game...
And let's say the ticker symbol FOR on the venture for those listening. Right. And this is gold and uranium, correct, if I recall?
Primary gold with uranium exploration. I just wanted to mention that, if you talk about a 25-cent stock, for example, this one, a 20% range one way or the other is virtually meaningless. So in this area of illiquidity that we deal with and deal with on a daily basis, 2 people want to buy the stock, it could trade at 30. 2 people want to sell the stock, it could trade at 18 cents. So really, I consider this kind of like this one of these things that's mostly flatlining. It traded a little higher, traded a little lower. It's a little lower right now. But in terms of an event, there hasn't been one. And so that's why nothing's happened in the share price. And again, it's something I fully expect to have to deal with. And I don't know if it's this year or next year, but I know that in my way of measuring these junior stories, it's one that I maintain a position in, and in fact, have also been buying on those days where, somebody comes out and says, I want out of this thing and I want out now. And, suddenly it might be trading at 16 or 17 cents. So, I've maintained the position and actually increased it. And what we're really looking for is news. And so, if the stock gets a little cheaper, then I take it as a buying opportunity. And when the stock goes up a nickel, I don't treat it as a selling opportunity because, these things take time. If you want to accumulate a position, again, because of the liquidity, you have to make liquidity your friend. You can't be scared off by it. So I look forward to those random sellers that might come along, with no motivation other than they need some change, or they need to, for whatever reason they may have. If the story in itself has not really changed, if it's intact, then I treat weakness as a buying opportunity. So let's just take a quick look here. Why was I excited about this and remain, a happy shareholder? Basically because of their assets. They've got, give or take, 1 million shares in Saskatchewan, 1 million ounces indicated in Saskatchewan, another 1 million in Mexico. I didn't put the grades on here, but they're over a gram per ton. And found a little report yesterday on the internet from Cypher Research, which was quite interesting. And it did a whole analysis of what are ounces in the ground worth. I can't remember the number of companies they looked at, but they looked at a very significant number of companies that had been involved in acquisitions, had been bought, and over a 23-year period, and determined that the average, and it's a very large spread, but the average value of an ounce in the ground is $63 of acquisition value. So I wanted to point out a recent transaction. So this is a transaction that just occurred in the last few months, which was Step Gold acquiring a company called Anacortes. And that company was bought for $8 an ounce. So I consider that a very low number, and I think there's reasons why it's a low number. Excuse me. There's reasons why it's low. A, we have a terrible market. We have, I think, the worst junior market I've ever seen, frankly. And you also had an asset in Peru, and Peru's not everybody's favorite jurisdiction these days, to say the least. So nonetheless, they still did a transaction valuing their deposit at, and by the way, similar to Fortune Bay in the way of size of deposit. It's a similar type of project, but they got $8 an ounce. So here we have Fortune Bay still trading at under $3 an ounce in the market. So an $8.6 million market cap, under $3 an ounce in the ground. So the box, Athona, that's the Goldfield project in Saskatchewan, has a current PEA on it. Very robust numbers. I would suggest if anybody's even thinking about buying this stock, just go and read the PEA, have a good look at it. And the Iquiton in Mexico, I think, is officially determined now as a historical document. I can't remember the exact lingo, but it's not a current PEA. It's a historical. So that would need to be upgraded for them to ever, to carry on and ever see the light of day on that deposit. But recently they've been announcing that they are resuming work there. So we probably see a revised PEA on that maybe within the next, I don't know. I don't want to even guess, maybe a year, who knows, maybe a little longer, but they are going back to work in Mexico as well. So it still remains to me to be a very good story to hold.
Any value to the uranium exploration?
The value there, I think, can only be measured in the sense of, let's call it human capital, because the guy who's doing that work is Dale Varon, who worked for Denison for years and knows the Saskatchewan uranium situation better than anyone. So have they come up with anything of real interest to date? No, they haven't. And that's a little bit of a kicker, if you like, on the story. Nothing much to report there, although they were modestly encouraged with the initial results. But it takes a lot to move a market these days. They weren't market moving results. They just sort of demonstrated that they were kicking tires in the right kind of area. But I would honestly value that right now at zero, and that may change over time. But the only other thing I wanted to point out on this Fortune Bay just is the sensitivity to improving gold price. And it's pretty clear there that the interesting thing is that if gold goes up 18%, the net present value of the deposit goes up 61%. So, these stories, they just provide a lot of upside if you get the right move in the commodity and management is able to execute. So it remains a sleeper, but it's one that I maintain the position in and buy occasionally.
And our third one we talked about last year.
Right.
And let's give the full name and ticker for this one too, please.
Yeah, Grounded Lithium, ticker GRD. This is the one that's been a disappointment. It's in particular disappointing because lithium has remained very topical, and many lithium stocks are doing quite well. So this is the kind of, going back where we started today, you can do your work, you can, feel good about management and the project and many aspects of the story and still end up with a stock that's lost, I don't know what the number is, Bill, 65% of value since we talked about it. Yeah, so, what I guess the real question is why? Well, there are some things that have happened, I think, over the last year that have resulted in that change. So if we want to just look at this slide for a second, there are some, there's a reasonable comparison to make with E3 lithium, which has done, extraordinarily well in the market in terms of, their cash costs and the grade and so on. Grounded is just, let's look at why it hasn't done well. So what I determined here, and you can see it, good shareholder base. So unfortunately, I've had to put a no in there. I believe it started reasonably good, but I think the company made a bit of an error in launching a marketing program that targeted U.S. investors. And unfortunately, I find a lot of those marketing programs create the shape of a pyramid in a stock, a perfect pyramid. And sometimes they go lower when they're over. And in this case, it's actually gone lower. So, like it or not, marketing to the average people who read marketing materials, they're looking for hot trades. They're looking for short-term wins. I think if the company could do it all over again, they likely would have done it differently. So what ended up happening is that the stock did well, I think, for a time, but it was driven by short-term traders. And when the momentum started to come out of the buying, they left, and they left in droves. And I'd be surprised to think that there's any net buyers that resulted in that effort. And so they spent money that I think might have been better spent, in other ways. The other main differential between E3 and Grounded is that, E3 has progressed to the pilot plant stage. And when they announced that, the stock basically had a really, really nice run. Interestingly, developing DLE technology, this is one I find very interesting in a way, because if companies today come out and say, we're working on our own solution, they're able to get all kinds of grant money. So E3 got $27 million from the Canadian government because they were working on new technology that's considered green. And so a lot of fundraising opportunities can come about through that effort. Whereas Grounded said, we're not doing that. We like the technology we see that's already available. And so because of that, they were in a sense penalized. They weren't able to raise that kind of money for research and development. So that's kind of that one's a little bit of a head scratcher, frankly. But nonetheless, it means less exposure, less headlines, less money coming in the till, and that's something they're just going to have to work through. If they really truly believe that they've got a similar asset, granted smaller than E3, a fair bit smaller, but a similar type of asset, the bet is still on, so to speak, Bill. if the asset ends up holding up, there'll be some kind of recovery, I think, in the share price. And most recently, they announced a private placement at 11 cents. Unfortunately, I wish it were higher, but it's at 11 cents, doing a small raise. And the interesting thing about that is that insiders are putting in $250,000. So I do remember being on a phone call with them and saying, look, one thing the market, I think, would really like to see is you guys stepping up to the plate. Well, I'm personally satisfied at this point in time anyway, that they are stepping up. It's not a ton of money, but for the, management group to throw in $250,000 of restricted shares at this point in time, frankly, is even better than buying on the open market, because, they're living with the 4-month restriction. They're doing the right thing. I think they're doing the right thing now. So we'll see. Again, going back to the portfolio, this one is still in play, I'd say. It's still a good chance of a recovery, but you've got to watch the press releases carefully, watch their action, and make a decision along the way. My personal decision is to stay with it. It's a good sector. They've had a few missteps, I think, but I don't think the story's over. And we'll just see how it continues to unfold.
And Mark, you don't use stop losses. So you're down, I think, around 65%, but some people do 25% stop losses or something like that. That's not something that you would employ.
Well, I personally don't believe in stop losses at all, whatsoever, frankly, in any way, shape, or form. And even in stop losses are only good for traders. And and we're talking here of extremely liquid stories that they may be day trading. Okay, I get it. Stop losses are a valuable tool. In any other situation, I just don't understand it. I think it's the wrong move. And as you come down the liquidity ladder, they make less and less sense, because these stocks can trade 25% down. As I said, 2 people decide tomorrow morning to sell their position, you can be down 25%. But is that a real down? I mean, that could be just, down 20% on 10,000 shares, on 20, 30,000 shares. It's a meaningless number to me. So, I mean, I could go on at length about stop loss orders. I think they're actually dangerous, frankly. And, even in the commodity markets, I think the guys who have a lot of experience there, they can see those stop loss orders, and they love cleaning out the stop loss orders around 3 a.m. on those, those contracts that trade 24/7. They have more fun cleaning out those stop loss orders than anything. So I strongly avoid them in all circumstances, frankly.
Was grounded lithium over the last year a little hard too, because like you said, lithium is booming. Some of these lithium explorers are going crazy based on an idea, and then you feel like you have something real here and it's down, 65%.
Yeah, I mean, that just opens up perhaps another thing we could talk a little bit about, and that is, promotion. Some companies do it better than others, and some, I think, and I'm not suggesting anything negative about E3, but there are some very seasoned people involved in that company that know their audience and perhaps know a little bit more about, like it or not, I hate to say it in these words, but they know how to run a stock. They know the game. So yeah, the promotional aspect has been strong in that story. And at the end of the day, perhaps rightfully, we don't know where these things are going to end right now. There's still the whole lithium brine space. While it's, there are some examples worldwide of it being used at scale, it's still new. It's still a new technology. Each deposit's a little bit different. So we'll just have to, be a watcher and waiter for the time being. But, you're absolutely right. You pick the sector right. You pick the right asset. You pick a fairly safe jurisdiction with a fairly, a management group that's had some success in the past, and it's not working out. So let's go back to that first slide. I mean, it just, these things can happen. But again, for myself personally, it's not over. So I'm not going to say the happiest holder on the planet, but I'm maintaining the position.
And are you a little bit of an activist investor? Because you're sharing your thoughts here on thousands of people are going to listen to this. Would you consider yourself an activist investor?
I would say generally no. What I'm not afraid of at all is to speak to management and make some friendly, kind suggestions that I think would be helpful. And so I do that periodically.
Okay. And this is your last slide for today, this one?
Yeah. I just, you know what, Bill, too many people run away from past picks, so-called. And I certainly didn't want to do that. And so I took a little time on each one, and that's all I've got for you today in the way of slides. It was just, that was just a way to recap those three names. And for me to not be looking down at a piece of paper and trying to remember too many facts. So I jotted them down. And so that's all I've got for you today in the way of slides.
Yep. And Mark, I think what you pointed out in your first slide about how 4 out of 10 can often go to 0 when you're dealing with a high risk, high reward sector, that's something people don't factor in. I've had guests on this show, smart people, that have said, if you can get 40% of your picks right at this, you're going to be like the Warren Buffett of junior mining speculation. So that's something that people, even when they critique stock pickers, that they don't factor in, is that less than half of your picks are actually going to probably yield a good return, unless the macro situation and the hyped bull market is there to such a degree that everything goes up. The tide lifts all boats. So that's something I think that people seasoned in the sector, they understand that.
Yeah, I agree, Bill. I wish I had it with me. I don't. And I hope I'm not misquoting, but we did recently an analysis of all the wins over the past 11 years in the fund where I help out with ideas. And I wish I had it at my fingertips, but I think I'm going to take a guess here. I'm pretty sure. You know what? If it's wrong, I'll write a note at some point on your YouTube thing. I think it was something like 43% of the gains came from 5% of the names. And so, again, reiterating what you just said and what we started off with, it's the concentration doesn't come from putting too much money in. The concentration comes from, the fact that some of them just, as they can in this sector, just take off and reward you quite richly. And you just have to manage the others, in this best way you can.
And in a cyclical industry, do you think you need to stay on the sidelines strategically until those entry points come along?
Not in the way that I like to do things, Bill, because again, it depends on your size of what you're doing. It depends, because if you're doing it in small dollars and you're very good at picking bottoms, those are probably two things right there that I would advise against. A, you shouldn't be doing this at all with small dollars, frankly. And B, you'll never pick bottoms. But let's just assume for a minute that you're not looking to build serious size positions and you've got a real handle on timing. Okay, give it a shot, fine. But if you're looking to develop larger positions, you have to buy when over a prolonged period of time when nobody wants these things. Otherwise, you'll never get the position size that you're after. If you're looking to build certain size. So, we can occasionally own, 4, 5, 6% of a company, but it might take 2 years, 3 years to accumulate. And, so all of a sudden the lights go on, you can't buy size. You can only just buy a small number, because now you're in a crowded supermarket reaching for the same shelf that everybody else is. So, I don't approach things like that. I'm never on the sidelines and almost always largely invested. And that's ultimately again, the trick. Sure, it's nice. It's nice to always have cash available. But when you get an extended bear market, and I would say we're in one right now, cash management becomes a real challenge. You could think we saw the bottom 6 months ago and you've been slowly deploying, and all of a sudden you wake up one day and you go, okay, now I'm just waiting because, the funds have all been deployed. But by no means. I mean, I don't think sitting around with cash is the answer at all. Not for the most high torque names, because they will advance on a store on a PR where you'll be fighting to buy stock.
And if I recall from our prior conversations, like from a fund perspective, you don't think it's good stewardship to sit on cash either, because that's not why investors gave you that money in the first place. They wanted you to go find ideas.
Right. Yeah. I mean, I think that's true. Now, needless to say, you need to be a good steward of capital at the same time. So it's always a consideration, but large amounts of cash, I don't think should be waiting on the sidelines, unless, not in this particular endeavor. If you're dealing with super liquid, Bill, maybe, but then you still have to be a timing guy. And, there's been so many studies done, of the frailty of trying to, time the market and so on. So.
Well, Mark, I think we'll leave it at that. You came back on the show and you talked through your picks from a year ago. And I think this is a good demonstration, especially for newer resource investors, to really think through what your investment thesis was when you bought the stock. Now, a year later, look at it and say, what went right? What went wrong? Was it management's faults? Did I misperceive something when I bought the stock? These are all good processes to grow as investors.
Yeah, I think so.
All right.
Lots to think about. And by the way, Bill, I still learn something every day. There's no end, right? So, what I can't remember who it was that said that 90% of being successful is just showing up.
Yeah.
And so you got to keep at it, And there are times where you could feel like it's the best business there is on the earth, and there's the next day where you might just want to say, I've had enough. But, at the end of the day, you just have to barrel through all those various conditions and just keep at it.
Well, we'll leave it at that as the final word. Mark, thanks for coming on the show today.
Pleasure. See you again, Bill.